If you want to be successful in the world of investing, you need to know the basics. One of the basics is the difference between trading and investing in stocks. A lot of people think it is the same, but they are wrong. There are important differences you should know before you start investing your money. Hi, and in today's video, I will show you the 5 most important differences between trading and investing. Make sure to watch the video until the end, where I will reveal 2 great books you can read or listen to as a beginner. Now let's get started. 1. Goals. Let's say you have $10,000 to invest in the stock market. Congratulations! But now you need a strategy to make this money grow. You can do this by choosing to become a trader or an investor. The goal of a trader is to make some quick, often smaller, profits through buying and selling stocks during the day, thanks to the fluctuation in the stock market. That's why they are often called day traders. By doing this frequently and often enough, they hope one day to wake up and be rich. One of the world's most well-known traders is George Soros, the chair of Soros Fund Management, also known as the man who broke the Bank of England. But that's a story for another time. On the other hand, an investor's goal is to build wealth for generations to come. This is through buying parts of companies' stocks in the hope they will increase in value and generate income through dividends. One of the greatest long-term investors of all time is the world-famous Warren Buffett, also called the Oracle of Omaha, and the founder of the investing company Berkshire Hathaway. So what is your goal? I would love to hear it. Write trade or invest in the comments below. And if you like it so far, make sure to subscribe. Now, let's move to the next point. 2. Long-term versus short-term. Because investors intend to stay invested in the markets for a long period of time, they have a long-term view of the markets. Investors need to look at business cycles over months or years. During a business cycle's bottom, stocks and other asset classes are the best time to invest. That's why when the stock market crashes and everyone is selling, long-term investors look for cheap stocks to buy. This reminds me of a famous quote from Warren Buffett: "Be fearful when others are greedy, and greedy when others are fearful." Day traders, as opposed to investors, are concerned with short-term price movements and speculation. Their goal is to profit from intraday price fluctuations caused by a variety of factors, including daily market and company news. As a result, they tend to focus more on the short term. 3. Market volatility. Because the investor bases his investments on the long-term growth expectations of companies, day-to-day volatility in the stock market does not have such an impact on him. Long-term investors aim to outperform the market benchmark. The best known is the S&P 500 index. The S&P 500 index, or Standard & Poor's 500 index, is a basket of the 500 biggest companies in the US, such as Apple, Amazon, and Tesla. The index has historically provided an annualized average return of roughly 10.5%. Traders, on the other hand, need the day-to-day volatility in the stock market to make money. They are always on the look for stocks that are going up and down a lot on a daily basis, the more the better. This allows them to quickly bet on short price differences and make a profit. This is an important difference between investing and trading. 4. Fundamental versus technical analysis. Because long-term investing and trading are different strategies, they also have very different ways of analyzing whether to buy or sell a stock. Let's have a closer look at the main differences. The long-term investor will do a so-called fundamental analysis of a stock. They will take a closer look at the fundamentals of the company, such as revenues, cash flow, debt, and many other indicators. That's why it's called fundamental analysis. Based on this evaluation, they try to determine the true value of a stock. Did you know that the stock price and the true value of a stock are not always the same? For example, a temporary drop in sales can cause the price of a stock to fall even below its true value. If so, this could be a sign for an investor that the stock is undervalued and to start buying. Traders, on the other hand, will try to predict price movements by analyzing daily stock market charts, moving averages, and other indicators, looking for certain patterns that will give them a sign if a certain stock will go up or down. This way they try to find the right time to go in or out of the stock market. This technique is known as technical analysis. As market news will impact the daily price and movements of a stock, this means that technical analysis will require from you a more intensive follow-up compared to a long-term investment strategy. Something you should keep in mind if you want to become a trader. 5. Short-term versus long-term profits. Some countries, like the United States, want to discourage speculative behavior and want to encourage long-term investment behavior. That's why they tax profits from selling stocks differently. If you sell a stock that you own for 1 year or less, your profits will be taxed at a high tax rate. In the United States, this tax rate can go to 37%. As a trader, this is important to know because you will try to make a lot of short-term profits and pay a higher tax. On the other hand, if you keep that same stock for more than 1 year and then sell it, your profits will be taxed at a much lower tax rate. This is interesting to know as a long-term investor. In short, you can minimize your taxes by holding stocks for a year or more. So there you have it, the 5 most important differences between investing and trading. Let's have a short recap. With investing, your goal is to build wealth for the long term, as with trading you try to make some quick short-term profits. With investing you try to identify the true value of a stock by doing a fundamental analysis of the company. On the other hand, a trader will try to find the right time to buy or sell a stock by doing a technical analysis. Day-to-day market volatility is not that important for investors but is very important for traders. And finally, as an investor, you can profit from a lower tax on your profits, as for traders you could end up paying a high tax on your profits. If you would like to start day trading or investing, I suggest reading the following bestsellers. If you want to become a trader, I recommend you to read How to Day Trade for a Living by Andrew Aziz. This book will teach you where to start, how to start, what to expect from day trading, and how to develop your own strategy. Andrew Aziz has kept the book short so that you can finish it without getting bored. If you want to become an investor, I recommend you to read A Beginner's Guide to the Stock Market by Matthew Kratter. Matthew Kratter is an experienced fund manager and will teach you how he has profitably invested over the past 20 years. This book will teach you how to grow your money the smart way, how to buy your first stock, and how to pick stocks like Warren Buffett. This book provides you with everything you'll need as a beginner investor. If you're interested, I've put the links to the books in the description of the video here below. So there you have it. I hope you enjoyed this video. If you want more content like this, make sure to give it a thumbs up and subscribe to our channel. Thanks for watching, and I'll see you in the next video.